Welcome to the Canadian Investors Course, Session 14, Investment Strategies Commentary. Please note page 2, Terms of Use and Disclaimer. We request that you read it. Page 3 has a cartoon, and the byline is, I used to be a stockbroker, but I'm looking for a gig that's a little easier on the stomach. And the broker is standing in front of a booth that says drivers wanted for the roller coaster ride, apply here. This commentary is on a special topic called target date investing. This has become pretty popular with mutual fund companies, and you're going to hear more about it in the news. So first of all, what is target date investing? Secondly, as Yogi Berra would have said, it's déjà vu all over again. Who sells this product and what are the fees? And who really sells this product and what's wrong with it? What is target date investing? Well, target date investing involves mutual funds typically called lifestyle funds or age-based funds or target date funds. They have an intrinsic appeal that's hard to beat. The investment product operates under an asset allocation formula that assumes that you'll retire in a certain year and adjusts the asset allocation model as it gets closer to that year so that the equities reduce and the fixed income increases, supposedly to increase the safety of the fund. The target year is identified in the name of the fund. So for example, if you're 45 years old and you plan to retire at 65, and this is 2017, you would pick a fund with a 2037 in the name. Very simple. You make one decision and you do nothing for the next 20 years. People love the sound of that. And here's where it comes to the Yogi Berra comment. Déjà vu all over again. Remember those pie charts from session 2? Well, same old, just a different package. You buy into the strategy once and you'll transition from left to right in the pie chart mutual fund combinations as you age, so that you have more and more fixed income in the portfolio. In the pie chart method, an investment advisor changes the fund portfolios for you. In a target date method, the advisor buys it once, then it's all automatic. Who sells the product and what are the fees? Product sellers are IROC licensed advisors, insurance agents, MFDA salespeople, MFDA licensed bankers, and most IROC and some MFDA licensed people are also insurance licensed. The fees, the total internal fees are similar to the pie chart mutual fund solution. They tend to range from 1 to 3%. The higher fees are related more to the insurance industry solutions, and the advisor can sell this to you via a front-end load or a deferred sales charge. With the deferred sales charge, the advisor receives a 5% commission up front, and a lot of advisors still use this method despite all the press that suggests that they shouldn't. We recommend to buy this front-end load at zero charge because the advisor receives a 1% embedded trailer through the life of the ownership anyway, so why should you pay them anything up front? A 1% trail is very generous considering you're supposed to own this for life. Who really sells target date products and what's wrong with them? Although you were given a list of sellers, MFDA and insurance licensed sellers tend to sell this product, mostly. It makes work much easier and clients pay you for life. Some IROC advisors will sell this particularly via the seg fund format. Be very suspect if you're being sold this product with a DSC commission. You don't have to do it. Change advisors. Look for a DSC on your statement beside the fund product. It reveals a lot. Is the product going to be there for you after a 20 or 40 year period? History indicates it probably won't. So who is the target date strategy really serving? Well, I think we should answer that question. Clearly, it's serving the issuers of the product. Another major problem with this is today's interest rate levels. In fact, this is the elephant in the room when it comes to this product. We have discussed this in all the other CIC sessions. Bond yields currently are at all-time lows. That means that at some point, bond yields are going to go up. When bond yields go up, values of bonds will go down. They're lower today than they were in the 1930s Depression era. So if rates go sideways or go up in the future, Fees will eat up the bulk of your returns, and they will lose capital. These portfolio assumptions were designed when interest rates were historically normal, as in higher and falling. In a low interest rate environment where interest rates are likely to go up, this product does not bode well for the future. See the next page. This is why you need a trusted wealth professional. You need somebody to explain to you exactly what you're getting into. Refer to Gordon Pape's article of Saturday, April 1st, 2017. And in here, a summary is, for example, Sun Life Milestone 2020 Fund currently has 97% of its assets invested in bonds. That's consistent with safety, and it means investors are missing out on the returns being generated by the current equity bull market. The fund's average annual compound rate of return for 2016 was 0.9%, and so far in 2017, investors have earned just 0.04%. Compare that to the Fidelity Clear Path 2020 portfolio F-Series, just over half its portfolio in stock, which enabled it to have a return of almost 5% in 2016 and 2.5% so far this year. However, if the market should crash in the near future, participants will have more than half their pension assets exposed to what could be a precipitous drop in just a couple of years before they're about to stop work. That could be a financial disaster. So, first of all, what's happening? Well, traditional target ratios, in other words, stocks to fixed income, are changing. Overall rating on target date fund programs, not great. So if you have any questions about this, contact a trusted wealth professional. This is the end of the commentary for session 14.